What an insane start to the year. The German expectations for their economy is the lowest rating it has ever achieved. The S&P has had the worst start of the year it has ever had as well. And then oil pumped and dumped. It went all the way to $130 per barrel, and then dumped. It's now around 98 and trending down. Then you have the Russian invasion of Ukraine, and people think that Russia may even use nukes. China is thinking of helping out Russia as well. How do you invest in this crazy environment where we don't know what to do? The Federal Reserve raises interest rates when all this havoc is going on because they're trying to control inflation. Now, the truth is, of the matter is, there has always been a lot of instability around the world when it comes down to investing. There's always a reason for the stock market to go down, but in most cases, the market has a natural tendency to actually go up. If we look into the past, let's look at past time periods where you could have started investing. For instance, World War II, or the Great Depression, or Enron, when Enron collapsed and the housing bubble burst, or the start of the pandemic in 2020. All of these situations had monumental crashes or moves down. And the interesting thing about it is that the stock market is still here, despite all the fear that existed at that time. The truth of the matter is, anytime you look into the past, the stock market is way higher than those events. Of course, at that time period, it was very scary. People were selling like crazy. But the truth of the matter is, over the long run, the businesses are still around. They're actually increasing their profits because they're more productive and they're able to raise prices if there's inflation. And then unemployment has had a natural tendency to go down over the years. So despite what you tend to get day to day, you actually do have this natural progression where the economy actually has a natural tendency to get better. Now, when it comes down to investing, it's also important to realize, no, we do not have control over world events. I can't decide how a war goes out and can't predict when the next pandemic happens, but there are things that we can control. For instance, when you do make investments in the stock market, it is a good idea for you to carefully think about how you would feel if the market were to decline. Would you panic sell? Would you actually decide, you know what, this is too scary, I'm going to sell at exactly the wrong time? Because a lot of retail investors actually have a tendency to panic sell, and they sell at the bottom, and then they, as the market goes up, they will actually have a tendency to discount it and think that it's not real. Oh, I don't want to invest. This is not a real rally. It's still a bit too close to the bottom, and I don't think that's real. And so they won't get back in. Then when people are starting to get greedy again, they'll start buying way at the top and they'll lose the money twice. And that happened in 2000 and in 2008. And it's a sad thing because it's just a signal that people tend to do the exact opposite of what they should be doing. So let's get back to the issue of control. You have control over your portfolio. You can think about issues of risk and how you would act even before the events happen. For instance, if you are not able to handle volatility, if you don't want your portfolio to possibly go down, 20-30%, which happens from every few years, it seems, well, stocks might not be the right investment for you. Maybe real estate is a better one, or bonds, but you have to consider that there are other consequences that you take when you make a financial decision. For instance, bonds don't really keep up with inflation. So are you okay with that? If you don't care about that because it's kind of more of a slow drip, and so it's psychologically not damaging, like losing money fast, then maybe bonds are okay. But a lot of people are okay to accept a little bit of volatility in order to actually achieve more of their financial objectives over the long run. That's one reason why people tend to choose stocks over bonds. It's also important to keep in mind what you're investing for. I think it's a good idea for people to have goals, to actually understand that there's a real objective, that at the end of the day, that it's not just numbers, that you have something in mind. So if it's a long-term objective, then of course stocks are probably a good investment, especially if it's an index fund, because then you're not really taking the risk that any one company will go out of business. but you have to have some goal in mind, because I think this is where people tend to make the biggest mistake actually. The problem with a lot of people is that for them, investing is a matter of being right. In other words, having the coolest stock like Tesla, or almost day trading it, and like the Wall Street bets people. And instead, it's important to realize this is a real serious investment. What your goal is to actually beat inflation, not take too much risk, and actually get ahead long run. But I think a lot of people think of it too much in terms of it being a game, or as a form of passive income in a way, because they just think of that the stock market has to be up every single year, and the truth is that doesn't happen. You have to consider the unpredictable situations that will happen from time to time. Another thing to keep in mind is your equity account balance. And if you want it to go up, you need to smash the like button and subscribe. But anyway, what is really important about your equity balance is if it's going up or down too much on a given day, in other words, more than 2 or 3%, maybe you don't like those kind of wild fluctuations, then you really need to consider adding more non-volatile assets to your portfolio. This means maybe more cash or bonds, or there's also staple coins. As the other issue is there are less volatile stock ETFs as well, where the goal, at least the goal, it doesn't mean it will be achieved, the goal is to have a less volatile portfolio. So there are options where you can buy portfolios, buy indexes that seek to get less volatility day to day. Now, sometimes they don't meet that objective, but that's something you need to consider, is that you could do this before crazy, unpredictable events happen. You don't even have to predict when they will happen, because I can tell you and assure you that when today's headlines disappear, there will be new events that also will be very unpredictable and spook the markets, and that's something you need to consider before it happens actually. Another thing to keep in mind is keeping your costs low. A lot of YouTubers actually do not talk about the idea of keeping your costs as low as possible, but in terms of investing, because there's a wide difference in terms of what kind of how much it costs yearly to actually own some of these ETFs. Now, Vanguard has some of the lowest expenses, but they're not the only one that is focused on low expenses. Fidelity actually has one fund, I believe, that charges zero. There's no charge whatsoever, but it basically includes every stock on the entire stock market. So it is really diverse and diversified. But the problem is that oftentimes comes at the expense of lower performance, because if you have every single stock, it also means that you have every junky stock as well. For instance, when it comes down to keeping expenses low, if in the old days some of these mutual funds used to charge around maybe 1%, think about it, you're paying 1% of your entire portfolio to some mutual fund company. That adds up over time, and it will actually result in you having a much lower return than the advertised index. And then finally, one thing I think that's really a good idea that a lot of people should look at is, if they are long-term investors, take a look at the long-term chart of the S&P. It is one of the most incredible charts out there, because over the long run, the S&P has had this upward trajectory. Yes, they do have down years as well, but they actually tend to be a lot more shallow than the NASDAQ. The NASDAQ is the wild one because they have the technology stocks, and technology stocks tend to be a lot more expensive to own. What I mean by that is you're paying more, you're buying companies with higher P's. So if you're in a time period where the amount of money people want to spend for these stocks, if they want a lower P, those stocks are going to go down a lot. Whereas S&P, they tend to be a lot closer to fair value. Of course, they get a little expensive too, but they're closer to fair value usually. And as a result, out of the last 20 years, the S&P has only been down 6 of the last 20 years. And that includes this year, because at the moment it's down. So if you enjoyed this video, click like, subscribe, continue to invest. It's a good idea to be informed about world events, but be aware that while world events can be scary, oftentimes by the time you hear about the events, it's already been priced in, and it's very hard to actually predict what's going to happen next. And one thing for sure though, well, almost certain, is that the stock market has a tendency to go up long term, unless you're the Russian stock market where it went down like 98% or something like that recently. So that's the ultimate black swan event. Anyway, hopefully you're not invested in that market. Subscribe, hit the like button. I'll see you in the next video.